If you understand accounting process, you understand accounting. Every financial accounting question, whether it looks simple or complex, is built on this exact cycle. Accounting is not random. It is a structured system, a logical flow of information from transaction to journal, ledger, trial balance, adjustments, financial statements, and closing. Everything begins with a transaction, a financial event that has a monetary value, affects at least two accounts, and keeps the accounting equation balanced. Accounting equation is assets equals liabilities plus equity. Every transaction must respect this equation. Let's start with a very simple transaction. The owner invests £50,000 cash into the business. Cash is an asset, so assets increase by £50,000. Equity, specifically share capital, also increases by £50,000. The accounting equation is balanced. Assets equals equity. Every increase on one side must be matched by an equal increase or decrease on the other side. This is the foundation of double entry. Transactions create movement within the equation. The journal is the book of first entry. It records date, accounts affected, debit and credit, and amount. Every debit must equal total credits. Now let's look at another example. The business buys equipment for £10,000 and pays cash. The business acquired equipment, so assets increase. At the same time, the business paid cash. Cash is also an asset, so cash decreases. One asset goes up, another asset goes down. In the journal, we record debit equipment £10,000, credit cash £10,000. Total debits equal total credits. The accounting equation remains balanced. Once transactions are recorded in the journal by date, they are posted to the ledger. The ledger groups transactions by account. This helps us see the balance of each account. In this example, cash increased by £50,000 when the owner invested and decreased by £10,000 when equipment was purchased. The ledger clearly shows the remaining balance of £40,000, so the purpose of the ledger is to show what each account balance is. Now that we calculated the balances of each account, the next step is to prepare the trial balance. Its main purpose is to check that total debits equal total credits. However, it is very important to understand that this does not guarantee that the accounts are correct. It only confirms arithmetic equality. A trial balance simply lists all ledger balances in two columns, debit and credit. In this example, we list all ledger balances. When we total them, debits equal credits, so the trial balance balances. Now we move to adjustments. Financial statements must follow the accrual principle and the matching principle. This means we record revenue when it is earned and expenses when they are incurred, not when cash is received or paid. So accounting is not about cash movement, it is about economic activity. Adjustments are the entries we make at the end of a period to convert our accounts from a cash basis to an accrual basis. First, depreciation. Assets lose value over time as they are used. If depreciation for the year is £1,000, we record debit depreciation £1,000, credit accumulated depreciation £1,000. Depreciation is an expense in the income statement. Accumulated depreciation reduces the asset's carrying value in the statement of financial position. No cash moves, but we recognise the cost of using the asset. Next, accrued expenses. This is when we have incurred an expense but have not yet paid it. The expense is recorded in the correct period, even though payment will happen later. Now prepayments. Suppose we paid £3,000 in advance, but only £1,000 relates to this period. We only recognise the portion used, debit expense and credit prepayment. The remaining £2,000 stays as a prepayment asset because it relates to a future period. This separates what has been used from what is still a future benefit. After recording all adjustments, we now prepare the adjusted trial balance. This means we update all ledger balances to include depreciation, accruals, and prepayments. The adjusted trial balance shows the final figures that will be used to prepare the financial statements. When we total everything, debits equal credits at £71,000, so the accounting equation still balances. Now the numbers are ready to be used in preparing the income statement and the statement of financial position. Now we reach the stage of producing the financial statements. There are two primary financial statements at this level: the income statement and the statement of financial position, called balance sheet. The income statement measures performance over a period of time. In our simple example, revenue is £15,000. We then deduct expenses, depreciation, accrued expenses, and other expenses. Total expenses are £4,000. Our profit is £11,000. This statement answers the question, did the business make a profit or a loss during the period? The income statement is about performance over time, not what the business owns. The statement of financial position is different. It shows what the business owns and what it owes at a specific point in time. In our example, we have under assets, cash, receivables, equipment, less accumulated depreciation, and prepayments. These represent resources controlled by the business. Under liabilities, we include accrued expenses and trade payables. They are amounts owed but not yet paid. Under equity, we show capital and profit. Profit increases equity because it belongs to the owner. The key concept here is, the income statement measures performance over time and explains how profit was made. The statement of financial position shows financial position at a point in time. It shows where the business stands financially at the end of the period. Now we move to the final step of the accounting cycle, closing entries. Revenue and expense accounts are temporary accounts. They only relate to one accounting period. At the end of the period, we must reset them to zero so the next period starts fresh. We transfer their balances to retained earnings through income summary. First, we close revenue, debit revenue and credit income summary. Then we close expenses, debit income summary and credit expenses. The remaining balance in income summary represents profit, which is then transferred to equity. After closing, revenue and expense accounts are zero. The new accounting period starts with clean temporary accounts while the profit remains in equity. So accounting continuous system always follows the same accounting cycle: transaction, journal, ledger, trial balance, adjustments, financial statements, and closing entries. This is the engine of accounting. If you understand this flow, you are not memorizing, you are understanding how the system works. And once you master this cycle, you master financial accounting.